A bear put spread is a vertical spread that aims to profit from a stock declining in price. It has a bearish directional bias as hinted in the name. Unlike the bear call spread, it suffers from time decay, so traders need to be correct on the direction of the underlying and also the timing. A bear put spread is created through buying an out of the money put and selling a further out of the money put. The maximum profit is equal to the distance between the strikes, less the premium paid. The loss is limited to the premium paid. Some interesting trades here with impressive max profit percentage. Let's take a look at the first item in the table, a bear put spread on Procter & Gamble, PG. PG bear put spread example. Using the April 14th expiry, this trade involves buying the 160 put and selling the 140 put. The price for the trade is $3.03, which means the trader would pay $303 to enter the trade. This is also the maximum loss. The maximum gain be calculated by taking the width between the strikes and subtracting the premium paid. 20 to 3.03 x 100 equals $1,697. The break-even price for the trade is equal to the long put strike, less the premium. In this case, that gives us a break-even price of 156.97. Let's strengthen our bearish screener by adding a parameter for any stock with a sell rating greater than 60%. American Airlines bear put spread example. The first example above is also using the April 14th expiry and involves buying the 16 strike put and selling the 11 strike put. The cost of the trade is $105, which is also the maximum loss, with the maximum possible gain being $395. The maximum gain would occur if American Airlines, AAL, stock fell below 11 on the expiration date. The technical opinion rating is a 100% sell with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. AAL is showing an 4 percentile of 64% and an 4 rank of 29%. The current level of implied volatility is 49.89% compared to a 52-week high of 77% and a low of 38%. Of the 13 analysts following AAL, there are 3 strong buy, 8 hold, 1 moderate sell and 1 strong sell recommendations. Let's look at another example, this time on Intel, INTC. Intel Corp bear put spread example. The first Intel example is using the April 14th expiry and involves buying the 47.50 strike put and selling the 40 strike put. The cost of the trade is $193, which is also the maximum loss, with the maximum possible gain being $557. The maximum gain would occur if INTC stock fell below 40 on the expiration date. The technical opinion rating is a 72% sell with a strengthening short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. INTC is showing an 4 percentile of 74% and an 4 rank of 53%. The current level of implied volatility is 34% compared to a 52-week high of 47% and a low of 20%. Of the 24 analysts following INTC, there are 3 strong buy, 1 moderate buy, 14 hold, 1 moderate sell and 5 strong sell recommendations. Mitigating risk. Thankfully, bear put spreads are risk-defined trades, so they have some built-in risk management. The most the INTC example can lose is $193, while the AAL trade has risk of $105. For each trade, consider setting a stop loss of 30% of the max loss.